Yo, the civilian unemployment rate rose to 3.9%, the highest level since February of 2022, just now. The thing is with these unemployment rate readings, when it's sustained and it starts a uptrend or downtrend, it sustains it for a while. Now, this is coming as no surprise if you've been following the channel, because we've been following the yield curve closely, more specifically for this example, the 10-year, 2-year. And if you go back on its history, we can see that the same thing keeps repeating every single time. I don't know if the unemployment rate on TradingView is updated, probably not. No, it's not. Okay, well it ticked up anyways to 3.9. But as you can see, it's clear as day, the same thing keeps happening every single time, right? Where the yield curve, which is the regular candles, goes first it goes into inversion. The unemployment rate it remains low. In fact, it can even drop into that. But it's signaling that there's problems ahead in the next 6 to 24 months, and there's a recession around the corner. But when it comes out of inversion and it goes into steepening, normally through bull steepening where the front end of the curve is falling at a faster rate than the long end of the curve. So the 2-year yield, for example, is declining quicker than the 10-year yield. That's normally bull steepening, which is bullish for bonds, bearish for the economy, because there is a crisis, and in a crisis people flee to what they deem to be a safe haven. And that's not typically a very good sign. Now, the stock market is up initially, and I'm going to go over the stock market as well and do some TA on it. But again, just to clarify, what is the bond market? Because this is relevant when it comes to talking about the unemployment rate and everything. In the bond market, anything between a 1 month to a 2-year period is a bill. A 2-year period to a 10-year period is a note, and a 10-year period to a 30-year period is a bond. When the yield curve inverts, it signals that there is, number one, banks don't make money, because how do banks make money? They make money by borrowing on the front end of the curve and then lending on the long end of the curve. If it's inverted, what happens? This is the 2-year yield and this is the 10-year yield. They're borrowing at a higher rate than what they're lending out at. That is a flawed business model. They're not meant to function in an environment like this. Alright, so this is why it normally predicts recessions. The yield curve still has to go up, and we're gonna go over what that looks like for the stock market as well. And you can see, if we overlay SPX here as well, in blue, the same thing happens every single time. You know, yield curve up, unemployment rate in orange up, stock market in blue down. Yield curve up, unemployment rate in orange up, and the stock market in blue down. Yield curve up, unemployment rate in orange up, and the stock market in blue down. Yield curve up, unemployment rate in orange up, and stock market in blue down. Yield curve up, stock market down, unemployment rate question mark. Well, it's starting to go back up now. And you can see we're still at pretty low levels, but this is the highest level since February of 2022. In fact, we were here in December of 2021. So it's the highest reading going back to February of 2022, but we were here 23 months ago. Alright, now that we have gone over the yield curve, actually just one last thing with it. So why is it bad? It's because, not just because banks are not making money, but because it's a warning sign, right? When people know that a crisis is coming, that's why they invert the yield curve. You could argue it's causative. Sure, it is. But it could also be a signal of something bad to come, right? Now, let's go over the stock markets. Also, the yield curve has a flawless, undefeated track record of being correct 11 out of 11 times since World War II. Alright, now we're gonna go over the stock market. I know I have a lot of trend lines here. They're all gonna make sense though. I'll make sense of all of them. We're gonna put on the 200-day, which is the yellow line, and the 200-week, which is this red line right here. So we had this downtrend right here, right? That looked something like this initially. And we broke above it. And then we had this massive rally, right? Now we had the uptrend line here as well, which looks something like this. Which, yes, we're above right now. The problem is, if we go to SPX like this, and we look at what occurred over here in September. I don't know if this is what's happening, but it kind of looks like it. You see how it was just like a vertical line up pretty much? 4 big green days in a row with 2 gaps in between, okay? After a pretty decent fall here. A fall of around 10%. And this right here was a fall of around, yeah, around the same amount. Here we have had 1, 2, 3, 4, and now we're on the 5th day. But notice what happened here. 1, 2, 3, 4, and then there's a gap down here. But if we go to SPX Future, you can see exactly what happened. 1, 2, 3, 4, and then on the 5th day we went up, so that one was green initially. That's what this wick here means, and then it just closed down bad, right? 1, 2, 3, 4, and we keep going up. Maybe this reverse is hard, and this is the beginning of something that looks something like this, right? I don't think this looks particularly good. We took out this horizontal level right here. Sure, we're back into this supply zone right here, but I don't think that's particularly bullish. We have bearish divergence. Again, this high is higher than that high, but the RSI is at a higher high than the previous high, which is a hidden bearish divergence. When the RSI makes a higher high, but price is unable to, it's telling you that there's more people interested in buying here, but price fails to go higher. Therefore, it's likely to not be a trustable move. So is this going to reverse like September, mid-September of last year? It sure looks like it. And normally this is not what's good for the stock market. But this is implying that the Fed is about to pivot. Somewhat. Okay. We need to see the yield curve uninverting through bull steepening to have that confirmed. And the 2-year yield looks really, really bad. Okay. This looks like it's about to plummet. You know, if you just go to a weekly chart here. I mean, just compare the rise here in the price, or in the yield rather, and compare it to the divergence here on RSI. This looks like it's about to fall over, and fall over really hard. Okay, can you see it here? A high, a lower high, a lower high, a lower high. But we keep making a high, a higher high, a higher high, a higher high, a higher high, right? So it just looks like it's completely unsustainable. So yeah, again, what we've been talking about for a long time, when unemployment rate goes, so does everything else. Markets might think it's good temporarily right now, but you can see how quickly this can reverse, just like it did over here. And this day right here actually ended up closing down 6%. I'm not saying that's what's going to happen now, but we could definitely get a wick and close the day red, and then it would look something like that. And keep in mind, the biggest rallies occur in bear markets. These are more like kind of a slow grind up, you know? Slow grind up. Besides this day right here where we went up 5.8% in one day. This is way too vertical, and this normally only happens due to short covering. And you can actually see that in the RSI even. Quite a lot of people shorting that are just getting burned. In regards to other trend lines that are important to hold, we have the COVID low trend line to the October low bottom, which is, if we were to come down here now, it sits at around 4040, roughly 4040. And that's also with this low right here. If you take out this low, well, there's probably going to be a little flush here. And then you have the 200 week just below. You have these two lows potentially pointing towards the next temporary low, which would make sense, by the way. There's actually a chance that you might see me bull if the stock market from current prices go down another 35% from here or so. I'll explain why I think there's a good likelihood that we actually bounce off of this level right here. But it also goes back to a more pessimistic future outlook. Okay, it wouldn't look good at least. Also, we have this previous resistance line, which could turn into support if we come back like this, right? Because this trend line was pretty holding us down pretty bad last year. And then we also have the one that's broken, right? This upward sloping trend line right here. Alright. So again, I think that today or Monday, one of the two will be really red. It could reverse today. I know the stock market is really excited right now. Oh, the unemployment rate is up. That's so good. That's good news. That means the Fed will stop. Alright, we'll look back at history and see if this is good news. It never is. Alright. Keep in mind, the reason why I'm so confident in a stock market crash thesis is because we have the inverted yield curve, which has been right 11 out of 11 times since World War II. We have the money supply contraction that has only contracted 4 times in the past 150 years, and it's always led to a Great Depression. 1870s, 1893, 1921, 1929. We have the math, if you compare the international debt versus the Fed funds, or the terminal rate, which we're sitting at 5.5%, and the speed of it. We have raised twice as quickly as in 2008, and there's 3.5 times more debt in the system. And then the chart also, with the Wall Street cheat sheet, all confirming the same thing. So we have the charts, we have the math, we have the yield curve, we have the money supply contraction, and then we have the lag effects in monetary policy. And the fact that some of the greatest minds in economic history all see the same thing. And like Milton Friedman said, the primary cause for the Great Depression was a contraction in the money supply. Alright. Well, that's it. I think the stock market is going to go down bad. So bad. And the unemployment rate is confirming that we are going to see a recession. This time is not different, and the yield curve is correct again. We will get a recession. But this probably won't just be a recession. Why? Because they never let the zombie corporations die. So, because of that, and because of all the malinvestments, you're likely to get the economic depression. Economic depression follow the huge bubbles, and also when they never had time to flush out the zombie corporations and malinvestments. That's why you see Great Depressions. There's an inverse correlation between interest rates and asset prices, but with a lag. So when the stock market has gone up only ever since 2009, right? If we go back and look at the chart like this, the stock market has gone up like this. It's because interest rates were suppressed. It's pretty simple. Look at this. It's literally just the inverse correlation. Interest rates up, asset prices down. But if it's the opposite, and it looks something like this, interest rates down, asset prices go up. This is what we have had for the longest time. So interest rates were kept low, so asset prices kept going up. Alright, well, what's happening right now? The opposite. So if we were to just put it like this, right? This era right here, it looked like this. Okay. But what happens now? On this side of the chart, ever since they started the rate hiking cycle around there. Okay? So on this side of the chart, this is what my generation is used to. This is what they're used to. That type of environment. But this is what we're heading into right now. And will they cut interest rates initially? Yeah, probably. That's not a good thing though. Because it takes a long time. Just like when they were raising interest rates, the market still went up. Well, it's the same thing to the downside. There's a lag effect in raising interest rates, but there will also be a lag effect in cutting interest rates for that to help the economy. So now what has to happen is like the CARES Act, which was the stimulus checks, the fiscal stimulus, and QE infinity, the monetary stimulus. 5 trillion plus 5 trillion. And by the way, another thing about interest rates that a lot of people don't talk about is how the balance sheet is down from $8.962 trillion down to $7.866 trillion. Jerome Powell himself said that for every $400 billion that gets removed from the balance sheet, that's equivalent to another half a basis point rate hike. So it's up to you. Do you want to live in denial about it, or are you seeing the cracks? Because it's not looking good. Okay. On top of that, this looks like the Wall Street cheat sheet, right? Do you think this is coming as a surprise? Wall Street cheat sheet picture. Right here. Not any similarity between the two? Huh. No, first you have something like this. And then you go literally vertical. Oh. Strange. Go literally vertical. Pull down. Pull down. Complacency. Complacency. Oh, soft landing, all that. Fed announces right here that they don't see a recession. And then boom. And why does this happen? Unemployment rate up. Alright, where are we on the chart? Over here, all the way since over here to over here, we were interest rates down, asset prices up. Well, what do we have now? Interest rates up, asset prices down. Ever since here to, I don't know, over here, right? When is that gonna be? Maybe summer of 2025 is my guess, but I don't know those things. I don't know the timing on that. It's really hard to say. I'm looking for certain conditions to be met. But the point is, let me get my chart back. Oops. The stock market definitely doesn't look healthy. Okay. And you might think that this is not a weird pump either, by the way. We made a video a couple of videos ago, like 2 videos ago, talking about how there was a hidden bullish divergence on the weekly here, and it was going to lead to a pump. But it was just going to be a dead cat bounce. That's all this is. And if you're so impressed by this right here, look, that's perfectly fine. But don't sit here and tell me that this doesn't look the exact same as this over here. This here was a pump of 6%. This here is a pump of 6% with 2 gaps in between. Well, I guess even 3. 1, 2 gaps, and then it went even higher, and then it crashed down, and it gapped down here as well. And you can see it in the futures. Went up, 5th green day, but it closed red, and it had like a really disgusting candle. So, draw your own conclusions, right? But this is the beginning of the end. Looking very bad.